$80 per ounce. That's the number that just shattered every record in silver's history. On December 29th, 2024, silver blasted through the $80 barrier for the first time ever, hitting an intraday peak of $82.61 before a mysterious and violent sell-off slammed prices down over 5% in a matter of hours. But here's what mainstream media won't tell you. This isn't just about record prices. This is about the convergence of three explosive catalysts happening simultaneously. China preparing to cut off 60-70% of global silver supply starting January 1st, 2026, the CME implementing their second margin hike in 2 weeks effective today, and a physical shortage so severe that buyers in Shanghai are paying $14 premiums over New York prices. If you own silver, trade silver, or have been watching this market from the sidelines, what's unfolding right now is nothing short of a market structure crisis that could redefine precious metals pricing for the next decade. Let me give you the numbers that Wall Street doesn't want you focusing on. Silver prices surged above $80 per troy ounce at the end of December, almost tripling their value from a year earlier. Read that again. Almost tripling. While gold has been making headlines with a meteoric rise of over 70%, silver has absolutely crushed gold's performance in percentage terms. Silver futures hit a new record high of $82.61 per ounce before pulling back. And spot silver briefly touched $83.99 on December 29th, 2025. This wasn't a gradual climb. This was an explosion driven by forces that have been building pressure for months while most investors weren't paying attention. The velocity of this move is what should terrify short sellers and excite physical holders. From August 2024, when silver was languishing around $26.61, we've witnessed a 216% increase in less than 17 months. That's not normal market appreciation. That's a structural shift in supply-demand fundamentals, colliding with speculative mania and strategic resource hoarding. The question every trader is asking right now is whether this represents the blow-off top that precedes a crash or the beginning of a genuine supply shortage that could push silver toward triple digits. Right on cue, just as silver was breaking out to all-time highs, the Chicago Mercantile Exchange deployed their most powerful weapon. Margin requirement increases. The CME announced its second margin hike in just 2 weeks, effective Monday, December 29th, raising the initial margin requirement for the March 2026 silver futures contract to approximately $25,000, up from $20,000 earlier this month. This is no coincidence. This is a calculated intervention designed to cool off what authorities perceive as excessive speculation and potentially prevent a derivatives market meltdown. But here's where the history gets chilling for anyone holding leverage long positions. In 2011, silver surged from $8.50 to $50. And as prices peaked, CME raised margins 5 times in 9 days, forcing leveraged funds out of the futures market and sending silver tumbling nearly 30% in weeks. The pattern is eerily similar to what's happening right now. And if you think 2011 was bad, consider what happened in 1980. The Hunt brothers accumulated more than 200 million ounces of silver leveraging futures to push prices close to $50 before CME's introduction of Silver Rule 7 effectively eliminated leverage, combined with Paul Volcker's rate hikes, crushing the rally and bankrupting the Hunts. The CME's message is crystal clear. They will not allow another leveraged blow-off top to threaten the stability of the derivatives market, regardless of what's happening in physical supply. The exchange is telling traders that if you want to play in silver futures with high leverage during volatile markets, you're going to need dramatically more capital, or you're going to get forced out through liquidation. This creates a cascading effect where traders who can't meet the higher margin calls start selling, which triggers stop losses, which forces more selling, creating the exact volatility spiral that the CME claims to be preventing. Now let us talk about the catalyst that's driving the real panic behind the scenes. China is impending export restrictions. Starting January 1st, 2026, China will enforce a licensing framework that replaces its previous quota system, effectively restricting 60 to 70% of the global silver supply to domestic use. Wrap your head around that number. 60 to 70% of global refined silver supply is about to be locked behind Chinese government licenses that will only be granted to large, state-approved firms. This is not a temporary trade dispute or a negotiating tactic. This is strategic resource nationalism on a scale we have not seen since rare earth export restrictions. China's Ministry of Commerce announced on October 30th, 2025 that starting January 1st, 2026, silver exporters must obtain government licenses with a minimum annual production requirement of 80 tons. That production threshold immediately excludes small and mid-sized exporters from the international market, consolidating control in the hands of state-owned or state-affiliated mega-producers. What does this mean in practice? It means China can turn the global silver supply tap on or off at will based on domestic needs, geopolitical considerations, or strategic trade negotiations. Silver just became a weapon in the same category as rare earths, semiconductors, and energy resources. The timing couldn't be more calculated. In October, China recorded record exports of over 660 tons of silver, with a large part of these deliveries going to warehouses in Western financial centers such as London and New York. Chinese exporters were front-running the restrictions, flooding Western markets with supply before the door slammed shut. But once January 1st hits, that flow stops. Western industries that have become dependent on Chinese silver for electronics manufacturing, solar panel production, and EV components will suddenly face a supply landscape where the dominant supplier is no longer freely available. Here's where the story transitions from regulatory drama to genuine crisis. The paper silver market, COMEX futures, London forwards, ETF holdings, is pretending everything is fine with normal contango and orderly price discovery. Meanwhile, the physical silver market is screaming shortage. COMEX inventories have reportedly dropped around 70% over 5 years, while China's domestic silver stocks are near decade lows. Let me repeat that. Exchange inventories have collapsed by 70%, while demand from solar, EVs, and electronics has exploded. The price divergence between physical and paper markets has reached levels that haven't been seen since the 2011 crisis. Shanghai physical hit 91, while COMEX closed at 77, a 14 premium for physical delivery in China compared to paper contracts in New York. That's not a small arbitrage opportunity. That's a market dislocation indicating that physical buyers don't trust the paper price and are willing to pay massive premiums to secure actual metal. When physical prices diverge from futures prices by that magnitude, it's telling you that one market is lying about reality. Historically, it's never the physical market that's wrong. The London forward curve is equally revealing. The London OTC market, where actual physical silver changes hands between bullion banks, refiners, and industrial users, is in the deepest backwardation in decades. Backwardation means the market is paying you more for metal today than for a promise of metal later. Spot prices exceed forward prices. That's the opposite of how commodity markets normally function, and it's a flashing red warning sign of physical scarcity. A year ago, there was normal contango with spot at $29 and the curve rising to 42. But today, spot is at 80 and the curve is falling to 73. The entire price structure has inverted, which only happens when market participants are desperately scrambling for available supply right now rather than trusting future delivery. Let's connect the dots on why China is hoarding silver domestically and why physical premiums are exploding. Silver is not just a monetary metal or an investment vehicle. It's absolutely critical for the technological infrastructure of the 21st century. Silver, designated as a critical mineral by the US government, is indispensable in solar cells, semiconductors, and advanced electronics. Every solar panel requires silver for conductive pathways. Every electric vehicle uses silver in electronics and charging systems. Every smartphone, laptop, and data center relies on silver's unique properties as the most conductive metal on Earth. The numbers on solar demand alone are staggering. Silver consumption for photovoltaics increased by 7.4% in 2021, 32.8% in 2022, and a staggering 63.8% in 2023, with forecast demand for 2024 at 232 million ounces. That growth trajectory is not slowing down. It's accelerating as governments worldwide push massive subsidies for green energy transition. China, as both the world's largest solar panel manufacturer and largest silver refiner, is looking at these demand projections and making the strategic calculation that domestic industrial needs outweigh export revenue. Here's the kicker that most analysts are missing. Analysts warn that prices near $134 per ounce would wipe out operating profits across the solar industry, potentially slowing adoption. Think about what that means. At $134 silver, solar panel manufacturing becomes economically unviable at current panel prices. We're already above $80. And if supply restrictions kick in January 1st while industrial demand continues growing, that $134 threshold could arrive much faster than anyone expects. This creates a death spiral for solar expansion. Rising silver prices, driven by industrial demand, eventually destroy the economics of the very industries driving that demand. Something has to give. Now let us talk about what's happening to all those leveraged traders who thought silver's rally to 80 plus was their golden ticket. The CME margin hike effective today is already forcing liquidation, and the carnage is just beginning. Higher margins mean higher capital requirements, meaning forced liquidation for the undercapitalized. If you're running 10x or 20x leverage on silver futures, and suddenly your margin requirement doubles, you have three choices. Post more capital immediately, reduce position size through selling, or get liquidated by your broker. For the vast majority of retail and smaller institutional traders, options 1 and 2 both result in selling pressure. The mechanics of how this kills rallies is brutal and precise. In 2011, margins started at roughly 4% of notional, meaning you could control $100 of silver with $4 of capital, 25x leverage, and CME ratcheted margins to roughly 10% over a few weeks, causing leverage to collapse from 25x to 10x, and the forced liquidation cascade murdered the rally. Today's margin hikes aren't quite as aggressive. We're already at roughly 17% of notional, but the psychological impact remains devastating. Every trader who lived through 2011 or studied that crash sees CME margin hikes as the death knell for precious metals rallies. What makes this particularly dangerous is the year-end timing. As Monday's margin hike takes effect, hedge funds face year-end rebalancing, commodity index adjustments loom, and broader market volatility is on the rise. Funds that need to reduce risk exposure before year-end reporting dates are now facing higher capital requirements at exactly the moment they want to decrease position size. That's a recipe for cascading selling, regardless of fundamental supply-demand dynamics. The CME has essentially weaponized calendar effects to maximum leverage, deleveraging at the worst possible moment for bulls. Here's where we need to step back and analyze what these competing forces tell us about silver's true value. On one side, you have regulatory intervention through margin hikes, designed to suppress speculative excess and prevent derivative market instability. On the other side, you have genuine physical shortage driven by China's export restrictions, multi-year inventory drawdowns, and exploding industrial demand. Which force wins? The answer depends on whether you're trading paper or holding physical. Critics argue that part of the current surge resembles a future squeeze, with limited deliverable inventory backing an oversized paper market. This is the fundamental disconnect. There's far more silver promised on paper through futures contracts and ETFs than there is actual deliverable physical metal to back those promises. When traders start demanding delivery instead of rolling contracts forward, the whole structure could collapse in either of two directions. Massive price spike to force physical holders to sell or default, and cash settlement because delivery simply can't be made at promised quantities. When physical diverges from paper like this, one of them is wrong. And historically, it's not physical. Physical buyers are voting with real money for actual metal they can hold, while paper traders are speculating on price movements through contracts that may never result in delivery. The 14th Shanghai premium over COMEX is just an arbitrage opportunity. It's the market telling you that Chinese industrial buyers value physical possession so highly that they will pay massive premiums to secure supply before export restrictions lock them out of international markets. Let us put this move in historical perspective because silver has a track record of explosive rallies that dwarf what we're seeing today. In 1979-1980, silver went from roughly $6 per ounce to $50 in a matter of months, a 733% increase driven by the Hunt brothers' accumulation and global inflation fears. In 2010-2011, silver rallied from 17 to 50, a 194% increase driven by quantitative easing and concerns about currency debasement. Now in 2024-2025, we've already seen a 216% increase from $26.61 to over $80, and unlike previous rallies driven primarily by speculation, this move is backed by genuine industrial demand growth and government-imposed supply restrictions. The difference this time is structural rather than cyclical. The Hunt brothers were speculators who could be forced out through regulatory changes and margin requirements. QE-driven investors in 2011 were momentum chasers who fled when the Fed started talking about tapering. Today's buyers include industrial manufacturers who need silver for production regardless of price, Chinese entities hoarding ahead of export restrictions, and investors who understand that above-ground inventories are being depleted faster than mining can replace them. You can't margin call a solar panel factory out of its silver demand. This is why the CME margin hikes might not work this time the way they did in 1980 and 2011. Those previous rallies were built primarily on leverage and speculation. Today's rally has a massive physical demand component that won't disappear just because paper traders get forced out. In fact, if margin hikes successfully suppress paper prices while physical demand remains constant, the only outcome is wider physical premiums, and eventually a complete breakdown in price discovery as paper and physical markets decouple permanently. Even Elon Musk, who rarely comments on commodity markets, felt compelled to weigh in on silver's supply crisis. Musk wrote, "This is not good. Silver is needed for many industrial processes," in response to posts about China's export restrictions. When the CEO of Tesla and SpaceX, companies that depend on reliable commodity supply chains for EV production and aerospace manufacturing, publicly warns about silver supply disruptions, that's a signal to pay attention. Musk understands better than most how critical silver is to the technological infrastructure his companies rely on. Musk's concern isn't about silver as an investment. It's about silver as an industrial input where supply disruptions could genuinely threaten production schedules and manufacturing capacity. Tesla's gigafactories require massive quantities of silver for battery systems and electronic components. If Chinese export restrictions create genuine supply shortages in international markets, companies like Tesla face the choice of paying whatever premium is necessary to secure supply or accepting production delays. That's the kind of inelastic demand that can drive prices into territory that makes current levels look cheap in retrospect. Let me game out 3 realistic scenarios for where silver heads from here, with specific price targets and timeframes so you can position accordingly. Scenario 1, the 2011 repeat, margin-driven correction. In this outcome, CME margin hikes successfully force enough leveraged longs out of the market to trigger a cascading liquidation cascade. Silver pulls back 25-35% from current levels, finding support around $52-$60 over the next 4-8 weeks. This would mirror the 2011 playbook where regulatory intervention crushed speculative excess regardless of underlying fundamentals. The catalyst would be year-end portfolio rebalancing, weak seasonal demand in January, and technical breakdown below key support levels, triggering algorithmic selling. Duration: 6 to 12 weeks of correction before physical demand provides a floor and the rally resumes at lower levels. Scenario 2, volatile consolidation, battle between paper and physical. In this outcome, paper markets remain suppressed through margin requirements and trader deleveraging, while physical markets continue showing extreme tightness through backwardation and premiums. Silver trades in a volatile $70-$90 range through Q1 2025, with violent intraday swings as different market forces battle for control. Neither bulls nor bears achieve decisive victory as physical shortages prevent meaningful price collapse, while regulatory pressure prevents explosive upside. This range-bound volatility eventually resolves when China's January 1st export restrictions create undeniable physical supply shortage that paper markets can no longer ignore. Duration: 8 to 16 weeks of consolidation before breakout in either direction. Scenario 3, the supply crisis. Breakout: physical overwhelms paper. In this scenario, which I believe is most likely, China's export restrictions starting January 1st create immediate and severe supply shortage in international markets that no amount of paper market manipulation can suppress. Physical premiums widen dramatically as industrial buyers scramble for available supply. Silver breaks out above $90, then $100, potentially reaching $120, $150 by Q2 2025, as the full impact of Chinese restrictions becomes apparent and mining supply proves unable to fill the gap. The catalyst is a breakdown in the COMEX delivery system, either through inventory depletion or a squeeze forcing cash settlement instead of physical delivery. Duration: 3 or 6 months of explosive upside before exhaustion. From a technical standpoint, silver just completed a massive multi-year cup and handle pattern with the handle forming between August and December 2024. The breakout above 35, the previous 2011 and 2012 resistance, was the signal that a major structural shift was occurring. The subsequent rally to $82.61 represented a 136% move from the August lows. And now we're in the critical zone where either this becomes a blow-off top or it consolidates before the next leg higher. Key support levels to watch: $72 or $75 represents the first major support zone where buyers might step in after today's sell-off. Below that, $65 or $68 is the 38.2% Fibonacci retracement of the August to December rally and would represent a healthy correction within an ongoing uptrend. If silver breaks below $60, that changes the narrative entirely and suggests the margin hikes are successfully killing the rally. On the upside, reclaiming $80 and holding above it for more than a few days would confirm this was just a shakeout and the trend remains intact. Breaking above $85 opens the door to triple digits without meaningful resistance. The volatility structure tells an interesting story. ATM volatility went from 27% to 40% year over year, with upside calls even steeper at 50-70% implied on out-of-the-money strikes. The options market is pricing in massive tail risk to the upside, which means sophisticated traders are paying significant premiums for upside protection despite today's sell-off. That's not the options behavior you see at market tops. It's what you see when smart money believes there's legitimate chance of explosive moves higher, even if near-term volatility is brutal. One of the most underappreciated aspects of this entire situation is the existential threat rising silver prices pose to the solar industry. Over the past year, solar industry profits have already fallen from $31 billion to $16 billion, while silver prices surged. Solar panel manufacturers are getting crushed between rising input costs and competitive pressure that prevents them from passing those costs through to customers. Many solar companies are already operating at razor-thin margins or outright losses, and further silver price appreciation could trigger widespread bankruptcies in the sector. This creates a perverse feedback loop that most analysts haven't fully grasped. Government subsidies and mandates are driving massive solar installation targets globally, which increases silver demand, which drives prices higher, which destroys solar manufacturer profitability, which could slow solar adoption, which might eventually reduce silver demand. But here's the problem. Solar accounts for only about 20% of total silver demand. Even if solar adoption slows dramatically, industrial demand from electronics, EVs, medical devices, and other applications continues growing. The solar industry's pain doesn't necessarily translate to silver demand destruction. What happens if silver hits $100 or $120 per ounce, while governments remain committed to aggressive solar deployment targets? Either taxpayers subsidize the solar industry even more heavily to offset rising input costs, solar adoption slows and climate goals get missed, or solar manufacturers develop alternative technologies that reduce or eliminate silver usage. That third option, technological substitution, is the only genuine long-term threat to silver demand, but developing and scaling silver replacement technologies takes years or decades, not months. If you're watching this video right now, you're part of a small minority of investors who understand what's really happening in silver markets while mainstream financial media focuses on surface-level headlines. Do me a favor and smash that like button so this analysis reaches more people who need to understand these dynamics before they make critical investment decisions. Subscribe to this channel if you want continued coverage of the silver situation as it unfolds. Because, trust me, this story is far from over and the next few weeks are going to be absolutely wild. Ring that notification bell so you don't miss updates, especially if prices make significant moves in either direction over the coming days. Let's dig deeper into exactly how China's export licensing system works, because the details matter enormously. Starting January 1st, 2026, silver exporters must obtain government licenses with a minimum annual production requirement of 80 tons. That 80-ton threshold is carefully calibrated to exclude the vast majority of smaller producers and trading companies from export markets. Most small and mid-sized silver producers and refiners handle far less than 80 tons annually, which means they can only sell domestically or through large state-approved intermediaries. This consolidation of export authority into the hands of a few large government-controlled entities gives Beijing unprecedented control over global silver flows. They can adjust export quotas based on domestic industrial needs, use export access as leverage in trade negotiations, or simply prioritize domestic supply security over export revenue. The licensing framework allows for graduated escalation, from reduced quotas to complete prohibitions, depending on geopolitical circumstances, mirroring China's rare earth export controls, where quotas were tightened incrementally over years. The strategic parallel to rare earths is instructive. When China tightened rare earth exports in 2010-2011, prices for neodymium, dysprosium, and other critical elements spiked by 500-1,000% within months. Western companies and governments scrambled to develop alternative supply sources, reopen dormant mines, and invest in recycling technologies. But all of that took years to implement, during which China maintained pricing power and supply control. The same playbook is now being deployed with silver, except silver's industrial demand is far more diversified and harder to replace with substitutes. There's another massive factor driving this silver surge that's getting overshadowed by the China story: dollar weakness. The dollar index fell to a new 2.75-month low amid bearish underlying dollar sentiment. When the dollar weakens, dollar-denominated commodities become cheaper for foreign buyers, which increases international demand and drives prices higher. But beyond simple currency effects, dollar weakness reflects concerns about U.S. fiscal sustainability, debt levels, and monetary policy that make hard assets like precious metals more attractive. Silver's dual nature as both industrial commodity and monetary metal means it benefits from dollar weakness through multiple channels. Industrial buyers in Europe, Asia, and other regions find silver more affordable in their local currencies when the dollar weakens, increasing demand. Simultaneously, investors seeking protection against currency debasement rotate capital from dollars into hard assets, with silver offering more explosive upside potential than gold due to its smaller market size and higher volatility. This creates a reinforcing cycle where dollar weakness drives both industrial and investment demand, pushing prices higher, which attracts more attention and capital, further accelerating the move. One scenario that could blow this entire situation wide open is a delivery failure or severe stress in the COMEX silver futures market. COMEX inventories have reportedly dropped around 70% over 5 years, which means the exchange's ability to facilitate physical delivery on futures contracts is increasingly constrained. Most futures traders never intend to take delivery. They close positions before expiry or roll them forward to future months. But if a meaningful percentage of longs started demanding delivery, or if a large player attempted to corner available supply, the system could break. The mechanics of a COMEX squeeze are straightforward but devastating. Let's say you're a large hedge fund or commodity trading firm and you believe physical silver is worth far more than paper silver indicates. You accumulate a massive long position in near-month silver futures with the intention of taking delivery. As your delivery intentions become known, other traders start piling on, believing you're going to squeeze the shorts. Available registered inventory on COMEX gets drawn down rapidly as you and others take delivery. Suddenly, short position holders realize there might not be enough physical silver in COMEX warehouses to satisfy all potential delivery demands. What happens next is either prices spike violently as shorts scramble to buy back positions and avoid delivery obligations, or COMEX changes the rules mid-game by forcing cash settlement instead of physical delivery, raising margins even further, or implementing position limits. All three outcomes have historical precedent. The Hunt brothers faced rule changes in 1980. The 2011 rally saw margin hikes that crushed prices. And various commodity markets have implemented emergency cash settlement when physical delivery became impractical. Any of these interventions would be massively bullish long-term because it would expose the paper market as unable to fulfill its fundamental purpose, providing price discovery and delivery mechanism for physical commodity. Let's talk about the massive disconnect between what Wall Street analysts are saying about silver and what's actually happening in physical markets. Mainstream financial media and bank research departments are generally skeptical of the silver rally, characterizing it as speculative excess driven by retail investor hype and technical momentum rather than fundamental supply-demand shifts. They'll point to historical precedent of silver rallies that ended badly, warn about the dangers of leverage, and suggest profit-taking at current levels. But here's what those analysts aren't telling you. Their firms are on the wrong side of this trade. Many large banks and financial institutions have been structurally short silver for years as part of broader commodities desks and hedging strategies. When they publish bearish research telling you to sell silver, they're talking their book, trying to get retail investors to provide them the liquidity they need to cover short positions or reduce exposure. This isn't conspiracy theory. It's documented fact that major banks have paid billions in fines for precious metals manipulation over the past decade. The institutional bias toward skepticism about precious metals rallies stems from a worldview where paper assets, stocks, bonds, derivatives, represent the legitimate financial system, and hard assets represent primitive relics or speculative vehicles. That perspective fundamentally misunderstands the role of physical commodities in industrial supply chains and as monetary alternatives during periods of currency instability. When a supply-constrained industrial commodity with monetary properties experiences genuine shortage, the paper market paradigm breaks down and physical reality asserts itself regardless of what Wall Street research says. One argument bears make about high silver prices is that mining supply will respond by increasing production, which will eventually ease shortages and pressure prices. In theory, 80+ ox silver should incentivize miners to ramp up production, open new mines, and increase exploration. In practice, the mining supply response is far slower and more constrained than simple economics suggests. Supply in 2023 saw a decrease of 2% due to a 4-month labor strike at Newmont's Penasquito silver mine in Mexico, with 2024 forecasted to see another decline in supply. The challenges facing silver mining supply response are numerous and structural. First, most silver is produced as a byproduct of copper, zinc, lead, and gold mining rather than from primary silver mines. That means silver production is largely tied to the economics of other metals. Even if silver prices triple, if copper or zinc prices don't support opening new base metal mines, silver supply doesn't increase proportionally. Second, permitting and developing new mines takes 5 to 10 years minimum due to environmental regulations, community opposition, infrastructure requirements, and capital intensity. Even if miners started today in response to $80 silver, new supply wouldn't hit the market until the late 2020s or early 2030s. Third, many historically productive silver mining regions face declining ore grades, water scarcity, labor challenges, and political instability that make expansion difficult or impossible. Mexico, Peru, China, and Chile account for the majority of global mine production, and each faces unique constraints ranging from water access issues to resource nationalism to regulatory complexity. The idea that mining supply will simply scale up to meet demand within a time frame that matters for current prices is wishful thinking disconnected from operational reality. Let me frame this situation in terms of potential wealth transfer, because that's ultimately what major commodity dislocations create. They transfer wealth from those caught on the wrong side to those positioned correctly. If we're entering a genuine silver shortage where physical demand exceeds available supply and paper market manipulation loses effectiveness, the wealth transfer implications are staggering. Every short seller, every bank that sold forward production, every manufacturer that failed to hedge future silver needs, they're all on one side of this trade. On the other side are physical holders, mining companies, and those who understand the supply-demand imbalance before it becomes consensus. The historical precedent for this is 1970s gold, when the dollar gold peg broke and gold transitioned from 35 fixed price to free market trading that eventually reached $850 by 1980. That wealth transfer from dollar holders to gold holders was massive and permanent. Many of those who repositioned wealth into hard assets during the early 1970s ended up with generational wealth that survived subsequent decades of inflation, currency debasement, and financial crisis. Silver today might offer a similar once-in-a-generation repositioning opportunity if the supply crisis thesis plays out. But, and this is critical, generational wealth opportunities come with generational risk. Silver is viciously volatile, markets can remain irrational far longer than you can remain solvent, and timing matters enormously. Buying physical silver at $80 and watching it drop to $50 on margin-driven selling would be financially and psychologically devastating, even if it eventually goes to $150. Position sizing, risk management, and emotional discipline separate those who capitalize on these dislocations from those who get destroyed by them. Drop a comment below and tell me, are you holding physical silver through this volatility? Or did you take profits above $80? Are you viewing today's pullback as an opportunity to add positions or a warning sign to reduce exposure? I want to hear from this community because collective intelligence often sees angles individual analysis misses. And if you found this deep dive valuable, if it gave you insights and analysis you're not getting anywhere else, share this video with other precious metals investors. We're building a community of people who refuse to accept mainstream narratives and do the work to understand what is really moving markets. So where does all this leave us as we close out 2024 and head into 2025? Silver just printed the highest price in its history, crashed violently in a matter of hours, faces the second margin hike in 2 weeks, is days away from Chinese export restrictions that could cut global supply by more than half, and is caught between paper market manipulation and physical market reality. The next 30-60 days will likely determine whether this rally dies like 2011 or becomes something far bigger. My assessment, and understand this is analysis, not advice, is that the physical supply fundamentals are strong enough to support significantly higher prices even if paper markets experience near-term volatility and corrections. China's export restrictions are real. They're happening January 1st, and they will fundamentally alter global supply chains in ways that can't be ignored or finessed through financial engineering. Industrial demand from solar EVs, and electronics continues growing regardless of price because silver is such a small component of final product cost that even doubling or tripling silver prices does not change the economics of an electric vehicle or smartphone. And above-ground inventories have been drawn down so severely that there's very little buffer to absorb any supply disruption or demand surge. The risk is that I'm underestimating the CME's ability to crush this rally through margin hikes, forced liquidation, and psychological warfare against leveraged longs. The 2011 playbook worked perfectly. Silver dropped from 50 to 26 in a matter of weeks after margin hikes forced capitulation. If that repeats, we could see $60 or lower before physical fundamentals reassert themselves. But even that scenario ultimately resolves bullish if the underlying supply shortage thesis is correct, because forced selling just transfers metal from weak hands to strong hands at better prices. Here's how I'm thinking about risk-reward positioning in this environment, and you can adapt this framework to your own situation and risk tolerance. First principle, avoid excessive leverage in silver futures or options, given CME's demonstrated willingness to change margin requirements without warning. If you can't survive a 30 to 40% drawdown in silver prices over 4-8 weeks, you're over-leveraged regardless of how strong you believe the long-term thesis is. The market can force you out through volatility and margin calls long before fundamentals validate your position. Second principle, physical holdings have different risk reward than paper instruments. Physical silver doesn't have margin calls, can't be confiscated by brokers, and provides optionality if paper markets break down or COMEX faces delivery issues. The trade-off is illiquidity, storage costs, and wider bid-ask spreads when you need to sell. For long-term strategic positioning based on supply shortage thesis, physical makes sense. For tactical trading around volatility, paper instruments offer necessary flexibility despite their counterparty risks. Third principle, incremental accumulation beats trying to time the perfect entry. Given the volatility we're seeing, 5% intraday swings, violent sell-offs from all-time highs, margin-driven liquidations, trying to catch the exact bottom is likely to leave you either buying too early and suffering drawdown or waiting too long, and missing the next leg up. Systematic accumulation during periods of weakness, dollar cost averaging into physical positions, and maintaining dry powder for genuine capitulation events offers better risk-adjusted returns than attempting hero trades at inflection points. One factor that could accelerate silver's move beyond anything we've discussed is geopolitical instability or conflict that disrupts existing supply chains. China's export restrictions represent controlled, policy-driven supply reduction. But what if there's a conflict in the Taiwan Strait that completely severs Chinese exports overnight? What if tensions in South America disrupt major mining operations in Peru or Mexico? What if sanctions regimes expand to include commodity exports as economic warfare intensifies? Any of these scenarios would create supply shocks that make China's licensing system look mild by comparison. The probability of these tail risk events might be low in any given month, but over a multi-year period, the cumulative probability becomes significant. And silver's role as both industrial input and monetary alternative means it benefits from geopolitical chaos through multiple channels: supply disruption drives, industrial shortage, while safe haven demand increases investment flows. This creates convexity in silver positioning, where you have capped downside if nothing extraordinary happens, but explosive upside if geopolitical situation deteriorates. Let me close with a warning about sentiment and contrarianism, because this is where most traders get trapped. Right now, after silver just hit all-time highs, sentiment is extremely bullish among silver investors. Social media is flooded with triumphant posts about the shortage, predictions of 100-plus-ing silver, and mockery of skeptics who missed the rally. This extreme bullish sentiment is actually a contrarian indicator. When everyone's bullish, who's left to buy and drive prices higher? But here's the paradox. Sometimes sentiment indicators fail because the underlying fundamental thesis is stronger than sentiment metrics capture. In 2020, when Bitcoin broke above its 2017 highs and entered price discovery mode, sentiment was extremely bullish. Many called for a top based on sentiment extremes. The way to navigate this is to separate your conviction in the fundamental thesis from your interpretation of short-term price action and sentiment. If you believe the supply shortage thesis is valid, then near-term sentiment extremes and corrections are opportunities rather than reasons to abandon the position. If you're primarily trading momentum and sentiment, then current extremes suggest taking profits and waiting for better entry after a correction. Know which game you're playing and don't confuse trading tactics with investment strategy. The next 30 days are absolutely critical. We've got CME margin hikes taking effect today that will force near-term liquidation and volatility. We've got year-end portfolio rebalancing and tax loss harvesting that could create additional selling pressure. And we've got China's export licensing system going live January 1st, which could create immediate supply disruptions, visible in physical premiums, exchange inventories, and industrial buying behavior. The collision of these three forces, regulatory suppression, seasonal flows, and structural supply change, will likely determine whether silver's rally continues or gets crushed like 2011. I'll be monitoring several key indicators to assess which scenario is unfolding. First, watch COMEX registered inventory levels, if they continue declining. Despite price corrections, it confirms physical shortage thesis regardless of paper price action. Second, track physical premiums in Shanghai, London, and other major markets. Widening premiums indicate paper markets are failing to reflect physical reality. Third, observe how quickly prices recover after sell-offs. If dips get bought aggressively within hours or days rather than developing into sustained corrections, it tells you there's genuine physical demand providing support. Fourth, monitor industrial buyer behavior through supply chain reports and manufacturer commentary. If companies start panic buying to secure supply ahead of Chinese restrictions, that's validation of shortage concerns. For those of you holding positions, managing through this volatility requires discipline and emotional control. Don't let a 10% down day shake you out of positions if your thesis remains intact. Do not let a 10% up day convince you to add leverage if you're already at appropriate position size. The next month will test your conviction and your risk management more than the previous 6 months of steady gains. This is where strong hands get rewarded and weak hands transfer wealth through panic selling or over-leveraged blowups. This is probably the most important video I've made about silver markets, because we're at a genuine inflection point where policy changes, market structure stress, and fundamental supply-demand imbalances are colliding in real time. If you found this analysis valuable, if it gave you frameworks and insights you're not getting from mainstream media or bank research, then do 3 things. First, hit that like button so YouTube's algorithm shows this to more people who need this perspective. Second, subscribe to this channel and ring the notification bell because the silver situation is evolving daily, and I will be bringing you updates as major developments unfold. Third, share this video with other precious metals investors, traders, or anyone interested in commodity markets and geopolitical economic shifts. Drop your thoughts in the comments. Are you holding through this volatility or taking profits? Do you think China's export restrictions will be as impactful as I've outlined? What price do you think silver hits by end of Q1 2025? Let's build collective intelligence through discussion rather than just consuming content passively. And if there are specific aspects of the silver situation you want me to dive deeper on, mining supply response, solar industry dynamics, technical analysis, option strategies, let me know in the comments and I'll prioritize those topics for future videos. We are living through a genuine market structure shift in one of the most critical industrial commodities and monetary metals. How you position for this determines whether you're on the winning or losing side of a massive wealth transfer. Stay strategic, manage your risk, and I'll see you in the next breakdown.